What if your next Ford just got a whole lot more expensive, and not because of better features or upgraded tech? We're talking thousands more, simply because of a political decision. That's exactly the storm Ford is bracing for, and it could cost the company billions. Ford has officially sounded the alarm. The company just pulled its earnings guidance for 2025, something it rarely does. The reason? Tariffs, massive ones, could take a $1.5 billion bite out of their profits, and that's just the adjusted earnings. The total impact could climb well beyond $2 billion this year alone. So what's happening? It all comes down to a sweeping wave of tariffs. The Trump administration has reintroduced, and in some cases expanded, 25% tariffs on imported vehicles and auto parts. That includes shipments from Canada and Mexico, which had been exempt under the USMCA. Not anymore. Starting August 1st, new 30% tariffs on imports from Mexico and the European Union are set to take effect. The language is broad, all imports. And while there's still some confusion about whether that applies directly to the auto sector, companies like Ford aren't waiting around for clarification. They're acting now. Ford's CEO, Jim Farley, has been blunt. These tariffs are already reshaping the company's pricing, sourcing, and even logistics. Ford is raising prices on models that depend heavily on foreign parts. It's rerouting key shipments through Canada using bonded carriers to avoid the worst of the tariff shock. And perhaps most striking, it's introduced a new employee-based incentive campaign under the banner, From America for America. The idea is clear. Build in the U.S., sell in the U.S., and try to insulate as much as possible from an increasingly volatile global trade environment. But even with all those efforts, the impact is massive. Ford has managed to offset about $1 billion of added costs, but they're still facing a $1.5 billion hit to their bottom line. That's after layoffs, logistics shifts, and pricing adjustments. And this doesn't even account for potential retaliatory tariffs or disruptions to supplier relationships overseas. If you're wondering how this affects you, here's the short version. Prices are going up. Ford expects vehicle prices in the U.S. to rise by as much as 1 to 1.5% this year. That may not sound like much at first, but on a $40,000 truck, that's $600 or more, just in added tariff-related costs. Multiply that across millions of vehicles, and you can see how big the ripple effect becomes. Consumers are already responding. In the first half of 2025, Ford saw a noticeable jump in sales. People are trying to get ahead of the price increases. And while that might give Ford a short-term bump, it's not sustainable. Eventually, the higher costs will catch up, and not just for buyers, but for dealers, suppliers, and workers across the board. There is, however, a longer-term angle. Ford's leadership believes this could push more manufacturing back to U.S. soil. If foreign-made parts and cars become consistently more expensive, the incentive to reshore production becomes stronger. That could mean more American jobs, more domestic investment, and less dependence on global supply chains. But that's a big if. Reshoring isn't simple. It takes years, billions in infrastructure, and political stability, something that's far from guaranteed right now. So where does this leave Ford? They're in triage mode, balancing cost cuts, shifting operations, and trying to reassure investors while navigating a policy landscape that can change with a tweet. Wall Street is watching closely. Investors still have some confidence that Ford can manage the chaos better than some rivals, but the mood is cautious. This isn't just a Ford story. It's a preview of what could hit the entire U.S. auto industry. General Motors, Stellantis, Tesla, they all rely on complex global supply chains. They all face the same squeeze if tariffs continue to expand. And don't forget our neighbors. Canada and Mexico are deeply integrated into North America's auto ecosystem. These tariffs don't just disrupt cross-border trade. They could strain diplomatic and economic relationships that took decades to build. In the end, the question is simple. Are these tariffs a smart strategic move to rebuild American manufacturing, or a costly disruption that could hurt workers, businesses, and consumers alike? For now, Ford's warning is loud and clear. The stakes are high, the costs are real, and the road ahead looks anything but smooth. So the next time you're at the dealership and the sticker shock hits harder than expected, remember, it might not be the car that changed. It might be the world around it.